Let's start by looking back in history. Asian economic crisis in the late 90s.
Yeah.
I think you can't help but wonder if this continues, Fed hikes rates, markets sell off, could something like that repeat itself now?
I think things are much better than 1997 when the Asian financial crisis broke out. Back then, emerging markets were borrowing in dollars short-term from the global banks. Now the structure has changed very much, and they've remedied many of the weaknesses. So, for example, they're now much more reliant on the bond market, and for the sovereign bond market, they borrow in local currency. But having said all that, that still hasn't quite insulated them completely from global conditions, because global investors are a big part of the local currency sovereign bond market. For Indonesia and for many other countries, the participation of global bond investors in the local currency sovereign bond market is up to 40%.
When you look at a country like Indonesia, so many people here and everywhere say it's an emerging market that has done just about everything right, and yet they have one of the worst performing, one of the hardest hit currencies in Asia this year. Why? What should they do? What haven't they done?
It just shows that the risk appetite of global investors, they fluctuate. And for local currency sovereign bonds, the currency moves tend to amplify the gains and losses. So when the dollar is strong and the rupee is weak, then the high yields are accompanied by the currency losses as well. So that actually amplifies the gains and losses through currencies. And so when there is a pullback, the financial conditions in emerging markets tend to tighten more. Now, I think there's no magic bullet in the policy response. We have to do the basics right, build buffers, stronger macro fundamentals. But also, I think there needs to be a certain amount of self-awareness that when the going is good and there's plentiful funding, this is not simply a vote of confidence in your policy. It is also a reflection of global financial conditions. And so don't be tempted to drink too much from the fountain of global liquidity.
Well, I'm glad you touched on that, because that's the crux of the matter lately, isn't it? Just was it 2 weeks ago we had that one, especially one big day of moving up in U.S. Treasury yields. A couple of days ago we get this big sell-off in stocks. Central banks are pulling back a lot of that liquidity, certainly the Fed and now the ECB. So when you talk about global conditions changing, boy, it seems like they've had quite a change dramatically just in the last few weeks.
Yeah, so the bond market has undergone some changes recently. And I think the backdrop here is that we're emerging from an extraordinary period when term premiums were negative. And so, the long yields were kept low through central bank policies, which were needed to take us out of the crisis. But it means that as central banks lift their finger from the scales, the term premium will have to decompress. And so we are seeing real yields going up. So I don't think it's anything extraordinary. We are going back to what is somewhat normal. And you were there at John Williams' conference on Wednesday when he gave this very important speech about now we're entering the realms of the normal, and we should be thinking about monetary policy in a normal context.
So let's bring in trade war angst, and maybe even with a special look at Korea, a very, export-dependent country intertwined in these global supply chains. How big of a factor is that in terms of what we're seeing in emerging markets, their currencies being hit, the global gyrations in these massive bond markets?
I think, the key thing, Kathleen, is that exchange rates have more than simply this trade rebalancing channel. There is a financial channel of exchange rates, and we see it in the fact that when the dollar is strong, financial conditions are tighter. And it turns out that, when we look at this empirically, looking at trade volumes, looking at real investment, the dollar exchange rate seems to also have a very important effect on real variables as well. And to that extent, the dollar exchange rate is a barometer of risk appetite.
And it's also something that a lot of discussion. Fed is raising rates. They've said they're going to keep raising rates. Dollar's going to potentially keep rising. Emerging market spillover. Have things changed in 20 years? Are people not realizing things are different, and maybe your whole approach to this has to be somewhat different than it was before?
Well, I think we have always lived in a connected world. So it is a bit of a cliche, but everything is connected to everything. In this kind of connected world, policies will inevitably have spillover effects. But everyone needs to do their part, and so you have to build buffers, build resilience. But also, when you're conducting monetary policy, you have to think about both the spillovers and the spillbacks. And the Fed has been very aware of that when the global economy is weak, that actually spills back onto the U.S. economy as well. So it is not true that the Fed has ignored the global economy.
Bank of International Settlements is that you deal with these central bank chiefs from around the world. What is their number one concern? What is the thing that, as the BIS, you are most trying to tell the rest of the world, the advice you're giving?
I think we're living in a global world, especially global financial markets. And, we've been on the record now for several months about the biggest risks in the global economy, which is snapback risk. Snapback of long-term interest rates. And I think, this is one area where, because we're living in a globalized financial market, long-term real interest rates, and we're seeing that the rise in long-term rates is reflected mainly in the real yields rather than expected inflation. And so this is really the discount rate that affects all the risk assets out there. And so when discount rates rise, you would expect to see asset prices fall.
So what is the biggest risk to the outlook for you? Because the outlook, apart from the trade war, maybe I shouldn't say that, because maybe that's the biggest risk against things continuing to grow, central banks normalize, we get kind of back to where we were before the crisis 10 years ago.
No, I think it's the interconnectedness. We're living in a financial system where, rather than thinking of each individual economy as islands, intermediated with trade, I think we're living in a world with interconnected balance sheets. And so as long as we actually keep that in mind and factor that into the policy discussion, I think we'll be in a much better place.
Do you think there's a risk the Federal Reserve will overdo and take rates continued too much on this path, particularly if you put it in this global context, or do you think? I
think the Fed is very thoughtful, and you saw John Williams' speech. I think that's very much reflecting the current thinking at the Fed. They're very responsive to what happens in markets, and they will adjust. But it's not really for me to speak on behalf of the Fed.
Getting back to this big question of the risk to the global economy. I want to be a little more specific now. If you had to put one at the top of the list, what is it? Where does it come from? I think we can look to the U.S. and Fed that maybe the biggest risk comes from another part of the world.
Yeah, I think, but because everything is connected, if you pick one risk, then you're actually associating other risks with it. So I think, I referred to snapback risk earlier, long-term rates going up. That is a scenario that's associated with a stronger dollar, and therefore, weaker fundamentals in the emerging markets. I think that is the concern where we then retreat in a way from these very accommodative conditions we've enjoyed for the last few years, with some impact on the real economy. So I think I would put that as the biggest risk.
It's interesting. We've focused so much on U.S., China, U.S., Asia, Japan, etc. Europe. Where does Europe fit into this mix?
Well, Europe is also part of the world.
Yes, it is.
And I think when we look at the fixed income markets in Europe as well, they're all connected, and we can focus too much on individual scenarios, idiosyncratic factors, and in a debt contract there are borrowers, but there are also lenders, and we have to focus also on the behavior of the investors. And I think if we can understand these two together, we'll be able to focus much better on how we can promote financial stability as well. In terms of the financial market stability aspect of this, you've talked about the dollar rising. Do you share the concern that some others have that after a long period of low, lots of liquidity, and now big central banks moving away from that, reducing their balance sheets, that some of the biggest risks might be the risk we don't see? Too much leverage? Absolutely. I think it's, leverage, I would say, is perhaps, at least leverage in the banking sector is not so much of an issue now as it was in 2007. So back in 2007, the risks were all concentrated in the banking sector balance sheets. And it was the banking sector deleveraging that really had this huge ripple effect across the world. The banks have deleveraged since then. And although it's true that debt levels are higher as a percentage of GDP, the banking sector is much safer, not least because of the work that we've been doing at the BIS with the Basel capital accord and so on. But I think you really put your finger on it, that we don't really know what the risks are until they materialize. And it's very difficult to foresee where the weak points are until something happens and all these weaknesses are flushed out.